Hi all, welcome back to IGNOU MBA. Today we are going to discuss the term and examination of MMPC-10 for December 2022. That is Managerial Economics. Okay, so let's go through the questions one by one. The first one, what you got is describe derivatives and partial derivatives as optimizing techniques used in Managerial Economics. In our text, Unit 3, Basic Concepts and Techniques. In this unit, we can see the topics of derivatives, partial derivatives and the optimization concept. Okay, so let's see the notes for it. In Managerial Economics, we can say that derivatives and partial derivatives, these are mathematical tools or techniques that are used for optimization and to analyze and optimize functions that represent economic relationships. Okay, so these techniques, they are particularly valuable for managers to take up the right decision, okay, so that they can maximize or minimize certain economic variables. Okay, so let's see what is derivatives. The definition for derivatives, what we can say is that derivatives represent the rate at which a function changes concerning one of its independent variable. Like in Managerial Economics, we often use derivatives to find the marginal impact of a change in one variable on another. Remember this keyword, marginal impact of a change in one variable on another. Okay, so it is used as an optimizing technique. We told that in our introduction, right? So these derivatives, they act as a tool to optimize functions, like to identify the critical points where the derivative is equal to 0. So it also points these critical points correspond to potential maxima, minima or points of inflection in the function. Let's see an example for derivatives. Like if a firm want to maximize its profit, the derivative of the profit function with respect to the quantity of output helps identify the output level where profit is maximized. And on the other hand, what is partial derivatives? It's an extended concept of derivatives. Okay, but here we take multiple independent variables. What about derivatives? There we took only one of its independent variables, and here in partial derivatives we take multiple independent variables. Okay, so it helps to measure the rate of change of function concerning one variable while holding other variables constant. Okay, so partial derivatives, they are used to optimize functions with multiple variables, like by identifying the critical points. Okay, for example, we can say in a production function with inputs like labor and capital, this partial derivative technique that helps managers to determine the optimal combination of inputs for cost minimization as well as product maximization or output maximization. Okay, for example of partial derivative, we can say that the partial derivative of the production function with respect to labor helps to identify the level of labor that maximizes output while keeping other factors constant. So these both techniques, that is derivative techniques and partial derivative technique, they both are useful for managers for optimization. Okay, so derivatives and partial derivatives are employed to find maximum or minimum points of functions. For example, firms may use these techniques to find out the output level that maximizes the profit and that reduces the cost production. Okay, it also play a crucial role in sensitivity analysis. Why? Because derivatives helps to analyze the sensitivity of one variable to change in another. Okay, so we can say that derivatives are crucial in decision making process because it helps the manager to understand like how changes in certain factors impact key performance indicators. Okay, then we can say they also helps in resource allocation. Like in cases where multiple resources are involved, partial derivatives, they aids in allocating resources very efficiently. Okay, so for instance, determine the optimal mix of labor and capital to achieve cost effective production, like how much labor and how much capital are required for the production, for an increase in production and a decrease in cost. All these things like the allocating of resources and these kind of things, partial derivatives play a crucial role. Okay, we also can say that in marginal analysis, this derivatives and derivatives helps, they are the fundamental in marginal analysis because marginal revenue and marginal cost, they are the derivatives of the total revenue and total cost. Okay, so equating MR to MC, it helps the firms to optimize their production level to maximize profit. So we can say marginal revenue and cost as well as marginal productivity. Here in marginal productivity, partial derivatives play an important role because it helps to calculate the marginal productivity of each input factor in the production process. So it guides the allocation of resources to for managers to take up the right decisions to achieve the optimal output levels. So in summary, we can say that derivatives and partial derivatives, they both are important tools or techniques that are used in managerial economics, and they serve as a powerful tool for optimization. Okay, and these techniques, they help the managers to take the informed decision regarding production level, resource allocation, profit maximization, cost reduction, and etc. Okay, now let's see the second question of our term and examination, that is briefly explain regression analysis. Describe how the regression analysis is used for managerial decision. This topic of regression analysis also come from our unit 3, basic concepts and techniques. Here we can find the topic regression analysis. Okay, so regression analysis is a tool that managers used in managerial decision making. Okay, so it helps the managers to predict what will happen, the future value of the dependent variable based on known values of the independent variable. For example, we can say regression analysis helps to predict future sales based on advertising expenditure, market conditions, and other relevant factors. So regression analysis, it has a causal relationship. It helps in identifying and understanding causal relationship between different variables. Okay, so managers can analyze like how change in one variable can bring about change in the another variable. Okay, for example, understanding like how employee training hours, it can impact their productivity of the employees. Okay, so these kind of causal relationships can be understood by doing regression analysis. It also helps in optimization. Like what we can say is that regression analysis helps to make optimized decision for resource allocation that helps to maximize the output level. Okay, and then comes the risk assessment. Regression analysis also helps to assess and quantify the risk that is associated with certain decisions. By understanding the relationship between variables, the managers can anticipate the potential risk that may happen in the future, and then they can take the strategic decision to reduce those risks. Okay, and one more thing is that regression analysis helps in price setting. Okay, because it understand like how different factors like cost, demand, competition, all these things influence the optimal pricing strategy. So it helps in setting the prices that maximize the revenue or profit. It also helps in resource allocation. Okay, so why? Because regression analysis assists in making informed decision on how the resources can be allocated to different factors that affect the desired outcome. Okay, and we can say regression analysis is also a valuable tool in market research because it understands the human or the consumer behavior. Okay, so managers can analyze how change in the strategic decisions or the marketing strategies, product features, all those things have what impact those things have in consumer preferences and purchasing decisions. Okay, it also helps in evaluating the performance. Okay, like for example, determining how changes in employee training programs can make impact in their performance metrics. So for example, we can say like consider a restaurant manager who uses regression analysis to analyze the relationship between advertising expenditure and the monthly revenue. Okay, so the manager, what he does, he collects the data on monthly advertising, how much capital he is spending on that monthly advertising and with the corresponding revenue of that month. Okay, so this helps the manager to estimate the impact of advertising on revenue, and it allows the manager to take the right decisions about advertising budgets, like for how much amount the advertising should be done in every month. All those things, the revenue expectations and all those things can be decided by doing regression analysis. Okay, so in summary, we can say regression analysis is a powerful tool for managerial decision making. It also helps the manager to take the informed choices to optimize the resource allocation and to reduce the risk in a dynamic business environment. So the third question from our term and examination is identify the variables included in demand function and explain its impact on demand. This question has come from Unit 4, Demand Concepts and Analysis. Here we can see the topic for demand function. Okay, so let's see what is a demand function. Like, it sets out the variables which are believed to have an influence on the demand for a particular product. The demand for different products, they are determined by a range of factors that are always not same for each of them. Okay, so the demand function, we can say that it is QD equal 5 of the other factors, the inputs, like price of the product or the price of the substitutes or income of the consumer and so on. So demand function, it represents the relationship between the quantity demanded of a good with the factors that influences the demand. Okay, so let's see how the variables have impact in the demand function. The variable, the first one we are going to see is the price of its own product. Okay, so in general, an increase in the price of good, what happens when the price of a good increases, it leads to a decrease in the quantity demanded of that product, right? Assuming all other factors remain constant, and this is what is called as law of demand. We know if a price of a product, if it decreases, what happens? The demand for that product will have an inverse effect. It will get increased, right? So the price and the demand, they have an inverse relationship, and this is called the law of demand. Then the next variable is price of complements. The price of complements, they have direct related to the demand for the given good. An increase in the price of complement can lead to a decrease in the quantity for the good. Okay, and one more thing is that price of substitute goods. If the price of the substitute good increases, that leads to an increase in the quantity demanded of the good. Okay, and one more variable, the important variable is disposable income. What happens if our income increases? Whenever our income increases, yes, our quantity demanded can also increase. Yes, because our purchasing power will get high. That's why disposable income, they have direct impact on demand function. Okay, as well as taste and preferences. A change in consumer taste and preference can also have significant effect on demand function. A positive change in preferences can bring about a higher quantity demanded, and vice versa. Then we can say advertising and promotion, they also plays important role in demand function. The increased advertising and promotion can bring awareness among the product in consumers, right? So that can lead to increase in the quantity demand of that particular product. And one more thing is that availability of credit. Availability of credit can also influence consumer spending. If credit is available readily, what happens? The demand also increases. And then comes rate of interest or price of credit. The rate of interest affects the cost of credit. Higher the interest may reduce consumer borrowing and spending, and this leads to a potential decrease in quantity demand. Then we can say is expectation. The consumer expectation about economic conditions, prices, or personal circumstances, it can also have an influence in their current purchasing behavior. So positive expectation may lead to increase in quantity demand. And then comes number of consumers in the market. When the number of consumers in the market increases, what happens? Generally, it leads to an increase in the overall demand in the market, right? And comes the other factors. This represent other factors that are not mentioned here in the equation that may influence demand. So understanding how each variable impacts the demand function is really very crucial for business to take a right decision regarding the pricing, marketing strategies, and resource allocation. Okay, so let's see the next question. Briefly explain the production function with one variable input. Okay, so here comes a fourth question. Briefly explain product function. In this question, we have to explain the product function with one variable input. Okay, this question has come from the unit 7, production function. Okay, here we can see the production function with one variable input. Okay, so let's see the notes for it. What is a product function? It is a functional relationship between the inputs and the outputs. This production function, it shows the maximum output that can be obtained for a given combination of input. Okay, so it's a very simple thing. What is production function? And it can be expressed like Q equals F of x1 comma x2 till xn, where Q, what it defines, Q means the maximum output quantity, and x1, x2, x3, so on. What it shows, they are the quantities of various inputs. Okay, various inputs. So what is F stands for? F stands for the functional relationship between the input and the output. Okay, so if we take any two input like capital or labor, how can we write the relationship between this? Yes, we can say that Q equal function of L and K, right? This function defines the maximum rate of output obtained for the rate of capital and labor input. Okay, so let's see the production function with one variable input. So from the topic, from the title itself, we can understand it is related to one variable input, right? So it describes the relationship between the quantity of output produced and the amount of a single input used in the production process. Here we have seen various inputs like x1, x2 and so on. In the second example, we have seen 2 input, right? Now the question here asked is one variable input. Okay, so we are using one input in this function. Okay, so Q equals function of L, where Q represents the quantity of output, L represents the quantity of the variable input. Typically it may be labor. Okay, so the key points what we can understand here is it increases the marginal returns. Initially, as more unit of the variable input labor are added to the production process, what happens? The marginal product of that input increases. This stage is characterized by increasing marginal returns. Then comes the diminishing marginal returns. After a certain point, what happens? The adding more units of variable input, it leads to diminishing marginal returns. Each additional unit that contributes less to the total output than the previous one. So the total product curve, what happens? It is the relationship between the quantity of the variable input and the resulting total output. Okay, so typically exhibits an upward slope followed by a flatter slope. So in this we can say the optimal input level. The goal for the firm, any firm, is what? To determine the optimal level of variable input that maximize the total output and minimize the production cost. So this occurs where the marginal product equals the marginal cost of the input. So for example, we can say like in a bakery where the quantity of output is determined by the number of bakers. They are labors. Okay, so here what is the production function? Q equals F function of labor. Okay, so initially when the bakery they hire more bakers, what happens? It increases the total output as they work together efficiently, right? But after a certain point, what happens when the bakers are added more? The bakery's kitchen may become overcrowded, right? And the additional bakers might get in each other's way, and that leads to diminishing marginal returns. Okay, so here the total product curve that showcase the increasing and then diminishing marginal returns. So by understanding the production function with one variable input, it helps the businesses to take the right decision regarding resource allocation, workforce management, production optimization, cost reduction, and etc. Okay. Now let's see the fifth question. How is break-even output determined? Explain with the help of break-even chart. In Unit 8, short-run cost analysis, we can find the topic break-even output level. Okay, so let's see what is break-even output. A break-even analysis, it is a fundamental calculation that helps the businesses to determine the point at which the total revenue, whatever the organization is getting from the total revenue, and that is equal to the total cost. So what happens when the total revenue is equal to total cost? What happens? There is no profit, no loss. Okay, so this is called break-even point. Okay, so the break-even output, it is the level of production or sales at which a company covers all of its cost, but it does not generate any profit. Okay, so in a break-even output level, we can say there is no profit or no loss. Okay, so I have said here to refer to chapter 8 because the notes given here is good, we can understand it. Okay, so generally a break-even chart, what happens? A break-even chart is a tool that helps to determine like what level of output in the short run the total revenue just covers the total cost. Okay, so let's see here the example. You have to learn this chart. Okay, so here we can see this is called a break-even chart. Here we can see in x-axis the output from 100 to 1000, and in the y-axis we can see the total cost or the total revenue. Okay, so let's see, for example, the firm's fixed cost is rupees 500. Okay, and the variable cost per unit is 4 rupees, and the unit sales price of output is 5. Okay, so how we can do the break-even output? We can let's see the formula for break-even output. So the formula is Q equal TFC by P minus AVC. That means Q Q, what it stands for? Break even volume of output. Q is equal to break even output. What it is? It is the total fixed cost divided by the price minus variable cost per unit. Okay. So from the example, let's see what is the total fixed cost and what is price and what is the average cost, variable cost. Okay. So here the fixed cost given here is 500 and the variable cost, what it is? Rupees 4, and the sales price is rupees 5. So when we put these values in this formula, what we get is Q equals fixed cost, we got 500, right? So 500 minus the price is rupees 5 and the variable cost per unit is 4 rupees. So 500 by 1, that is 500. So 500 is the break-even output. Okay, and the break-even output value, what is the break-even output value? 500 into the price, that is 5, that we get 2500. Okay, the next question comes here is explain long run cost functions. In unit 9, long run cost analysis, we can find the topic for long run cost. Okay, so let's see the note for it. Long run cost function, it refers to the relationship between the production cost and the sale of operation in a long run. Okay, so in the short run, it is not like unlike the short run, the long run allows for adjustments to all the inputs including the capital and the labor, but it is not possible in short run. Okay, so here in this context of long run, the function, it captures the minimum cost of producing a given level of output considering various combination of input. So let's see the main characteristic of long run cost functions. Okay, it mainly include flexibility in inputs. Okay, we have seen that in a long run a firm can vary all its inputs such as machinery, technology and size of its labors and so. So this flexibility enables the firm to optimize its production process and for cost efficiency. Okay, then we can say the major thing is economies and diseconomies of scale. In a long run cost function, it reveals the economies of scales at lower levels for production, where increasing output leads to proportionally smaller increase in cost per unit. So conversely, we can say what happens when does the diseconomies of scale emerge? The higher level of production, it causes an increase in cost per unit. Okay, so we can say this, it also helps in cost minimization. Okay, so the objective of long run cost function, what it is to determine the most cost effective combination of input to produce a specific quantity of output. Okay, it also helps in expansion or contraction of production. So a long run function, it allows the firm to decide whether to expand or contract its production capacity depending upon the market conditions or the shift in demands. Okay, so variability of cost curves. It can be U-shaped or L-shaped curves. It depends on the presence of economies or diseconomies of scale. Just learn to draw this long run total cost function. Okay, here we can see in a long run the total cost, the graph, it shows the relationship between the long run total cost and the output in the x-axis, right? So what we can see here is the result is the production of the last unit of output if the firm has to make the optimal changes in the quantity of all inputs. So understanding this long run cost function, it helps the managers to take the strategic decisions to optimize their production process, to achieve the economies of scale and to make informed decision. Okay, the next question comes here is explain different approaches of estimation of cost function. Next question is about cost function and the functional forms of cost function. Okay, in unit 9 production and cost analysis, we can find the topic estimation of cost function. Mainly there are 3 approaches for estimating the cost function. They are accounting, engineering and econometric. Okay, so let's see them one by one. So in accounting approach, it focuses mainly it relies on the historical accounting data. Okay, so for example, it examines the past expenditure, cost records and financial statement. But this approach, it has certain limitations, like it may not capture the future cost trends. Because why? It depends, it relies on historical accounting data, right? So it will be suitable for predicting cost under different condition. It is not suitable. Okay, next comes the engineering approach. This approach emphasizes the technical relationship between inputs and outputs. Okay, and this approach, it analyzes the physical production process, the input-output relationship. Okay, but it also have a limitation, like it may not consider economic or market factors that influence the cost. Then comes the econometric approach. Here, this approach incorporates the statistics and mathematical methods to estimate the cost relationship. Okay, so it utilizes the historical data and it identifies the relationship between input and output. But it has an advantage because why? It offers a more flexible and dynamic approach. So the most flexible and dynamic approach in the cost function, we can say it is econometric approach, okay, because it allows the managers for prediction under various scenarios. Then we have asked what is functional forms of cost function. Generally there are three functional forms of cost function. The first one is linear cost function, quadratic cost function and cubic cost function. Okay, the equation for each of them are given here. A linear cost function, it implies a constant variable cost per unit of output. So the total cost here increases linearly with the quantity produced. Okay, an example is given over here regarding linear cost function. Then comes the quadratic cost function. The equation is given here. The total cost is equal to A2 plus B2Q plus C2 Q square. Okay, so here both fixed and variable cost, and with the variable cost having a quadratic relationship with output. That is why this function is called as quadratic cost function. Okay, so here this function allows for capturing non-linear cost pattern. Here we have seen what kind of cost pattern? Linear cost pattern, right? And here in quadratic cost function, it allows you for capturing the non-linear cost pattern. We can see the example given for quadratic cost function. And then comes the last function is cubic cost function. Okay, so this is an extension of quadratic function. It introduces cubic terms, like we can see here Q, Q, L. Yes, so this allows for even more flexibility in capturing non-linear cost behavior. So the choice of functional cost function, it depends on the nature of the production process and the relationship between the inputs. Okay, next question is explain the characteristics of monopoly. How is equilibrium output and price determined in under monopoly? Okay, so what is the monopoly? Monopoly is a market situation. We know in monopoly it is a single firm, right, that controls the entire supply of a product, and that firm does not have, or that product does not have any close substitute. So the main characteristics of monopoly is the number and size of distribution of sellers. There is only a single seller, right? And there is no closed substitutes. And the number and size of distribution of buyers, it is unspecified. And is it free entry and exit? No, it is prohibited or very difficult entry for the conditions of entry and exit. Okay, so in equilibrium of output and price under monopoly, we can say profit maximization monopoly firm determines its output at that level when the marginal cost intersect with the marginal revenue from below. Okay, since the marginal revenue curve of the monopoly firm is below its average revenue or demand curve at all levels of output, what happens? The equilibrium output level, it is equal to the marginal cost and the marginal revenue. Okay, let's see the figure over here. We can understand it from here, the output, and here we can see the marginal revenue, average cost and marginal cost. Okay, so here the firm would enjoy supernormal profit even in the long run. Because why? Because it is very difficult for the other firms to enter into a monopolist market, right? So in a long run, what happens? A monopoly market, it earns supernormal profit. Okay, but in a case of perfect competition, it doesn't earn a supernormal profit like that of monopolist market in a long run. So the determination of profit maximizing equilibrium output and price under monopoly is shown here in this figure. Here DD and MR are the downward sloping demand, okay, or the average revenue curve. We can see DD, this demand, and the marginal revenue, these both are downward sloping demand. Okay, so here AC and MC are its average cost and the marginal cost curve. We can see AC average cost and the marginal cost curve. Okay, and at point E, what happens? MC intersects MR. Here at point E, what happened? MC intersect MR. Okay, here in this point. Okay, so the profit maximizing equilibrium output is what? OQ. That is at OQ output, OP equal QR. Okay, so at what? At the point OQ output, the price is OP equal QR, where the average cost is OC, that is equal to OQ. So the monopoly profits, they are equal to price minus average cost. So the formula, what we can get, the rectangular area of PCKR, it represents the supernormal profit of the monopoly under a long run. Where is PCKR? We can see it here, PCKR. This shows the supernormal profit of a monopoly firm. So here comes the end of this term and examination of December 2022 of Managerial Economics. Okay, so please study all these questions as they are very important and they can be coming repeatedly in the next term and examination too. Okay, so if you found this video as helpful, please do subscribe and share it with your friends too for more IGNOU videos. Thanks for watching.